Welcome back, everybody, to another episode of Main Street Money. I'm Andrew Gay with Texas Hill Country Advisors, and joining me today is my business partner, Gilbert Paiz. Gilbert, good to have you back, sir.
Thank you, my man.
As always, our goal here is simple. We take what's happening in the markets, the economy, and the world of financial planning and translate it into something useful for everyday investors. Now, we're recording this while the markets are still open on Friday afternoon, so some of the numbers may move around before the closing bell. But assuming markets finish roughly where they are at right now, this week feels very different than the previous few weeks or a few months even. Not because the economy suddenly broke, not because earnings suddenly collapsed, but because investors are beginning to accept a reality they've been fighting for most of this year. Interest rates may stay higher for longer than many of us expected. And that theme touched almost every corner of the markets this week. So let's jump right in. Segment 1, markets take a breather. If markets finish near current levels, we're likely looking at a negative week for both the S&P 500 and the Nasdaq, while the Dow has held up somewhat better. The S&P remains around 7,400, the Nasdaq remains around 25,800, and the Dow is still hovering around 51,400. Now, those numbers are lower than where they were a week ago, but let's keep them in perspective. The S&P remains up roughly about 8 to 9% year to date. The Nasdaq remains higher by roughly 12%, and the Dow remains positive on the year as well. So we're not talking about a bear market. We're not talking about a financial crisis. We're talking about a market that may simply be taking a breather after a tremendous run. One thing we talk about often on this show is markets are not linear. The S&P 500 has gained roughly 75% since the October 2022 bear market low. Historically speaking, that kind of move doesn't happen without periods of consolidation. So Gilbert, let me ask you this. When investors see a week like this after such a strong run, what do you think is the biggest mistake they make?
You know, I think the biggest mistake investors make when we have weeks like this is they think the market's going to pull back indefinitely and they want to wait, quote unquote, until things, quote unquote, get better. or go back in their upward trajectory, and that sometimes, in my mind, is a mistake,
right?
Because you're timing the market, then trying to gauge when the best time is to get into the market. If you are following a plan, doesn't matter what the market's doing, whether it's good, better, indifferent. You start the plan.
We all know that the statistics are not in your favor as an investor if you do in fact try to time the market. So investors often assume whatever happened this week will continue indefinitely, linear trajectory, and that's just not how it works. But successful investing usually requires a longer perspective than that. One difficult week doesn't invalidate a good financial plan. Segment 2, the economy remains resilient. So let's move to the economy. Despite market volatility, the underlying economic picture remains surprisingly solid. This week's employment report showed unemployment remained around 4.3%. Employers continue hiring, consumers continue spending, corporate America continues generating profits. And that's one reason we've avoided the recession so many economists were predicting over the last couple of years. Now, inflation remains above the Federal Reserve's 2% target. That's important because inflation is ultimately what drives interest rate policy. The current Fed funds target remains between 3.5 and 3.75%. Meanwhile, the 10-year U.S. Treasury, which is a benchmark interest rate for a lot of other interest rates out there, is hovering around 4.5%, while the 30-year Treasury is around 5%. Those levels we haven't consistently seen in quite some time, and investors are beginning to recognize that the Federal Reserve may not be in a hurry to lower rates. In fact, according to market pricing, there is now a meaningful probability that the next move by the Fed could actually be a rate hike rather than a cut. That's a dramatic shift from where expectations were earlier this year. Gilbert, you've been talking about this possibility for quite a while. So what do you think changed? Why do you think investors have shifted so dramatically from expecting cuts to now discussing the possibility of hikes?
Well, I think the number one thing is higher energy prices. Higher energy prices bleed through the entire economy. And with the war in Iran, lack of a resolution to the war, higher energy prices seem to be very, very sticky right now. And the longer that happens, the longer they stay sticky, the longer they stay elevated, the more likely we are to see elevated inflation and a potential for a rate increase instead of a rate decrease from the Fed.
And that's exactly what markets are wrestling with right now. It's not necessarily that the economy is weak. It's that the economy may actually be stronger than expected, and stronger economic growth often means rates stay elevated longer. Let's talk about the biggest support underneath this market. It's earnings or profit. At the end of the day, earnings drive stock prices.
They're supposed to anyway.
They're supposed to. That's right. And corporate America continues delivering. Current estimates show S&P 500 companies are tracking roughly 25 to 28% year-over-year earnings growth. That's an extraordinary number. We mentioned that on here before. Technology remains one of the biggest leadership sectors. Artificial intelligence continues driving investment in semiconductors, cloud computing, data centers, and infrastructure. But here's something important for investors to understand. This isn't just an NVIDIA story. This isn't just a technology story. We're seeing strength in financials. We're seeing strength in industrials. We're seeing strength across multiple sectors of the economy. That's generally what healthy markets look like. So, Gilbert, let me get your thoughts. When you look at corporate earnings today, do you think investors are too focused on AI headlines and missing the broader earnings story?
Yes, I do. And of course, today is an interesting day because there's a very popular, well-known space venture company that is IPOing today. And there's a couple of other AI companies that have announced plans for IPOs later this year. I think a lot of investors were, and I think rightfully so, maybe earlier this year, focused on AI and technology as the best performing sector, which they have been. But if you look at, as you pointed out, the data, the increase or the upswing that we've had in the market has been broadening out somewhat over the past several months. And I think that's a good indicator that this is not just a technology story or an AI story.
Yeah, that's a great point. And the strongest bull markets are usually supported by broad earnings growth. No surprise, not just one exciting theme like the AI theme that we're talking about. And right now, earnings remain one of the biggest reasons investors continue to show confidence in the market. Segment 4, Financial Planning Corner, the danger of holding too much cash. So every week, we try to connect what's happening in the markets to a real-world financial planning concept. This week, I want to talk about cash, because whenever markets get nervous and interest rates move higher, we start hearing the same question: should I move everything to cash? And honestly, that's a reasonable question. Money markets are yielding around 4% right now. Short-term treasury bills are yielding attractive rates. Cash feels like it's finally paying something again. The problem is that cash can create a different type of risk, purchasing power risk. Let's say inflation averages 3% over time. $1 today won't buy the same amount of goods and services 20 years from now. And that's particularly important for retirees. We're living longer now, spending more time in retirement. Many retirees today could easily spend 25, even 30 years in retirement. And that's a long time for inflation to be working against you. So while cash absolutely has a role in a financial plan, cash is usually a tool. It's not a long-term investment strategy. When we talk to clients and they start talking about moving everything to cash because markets feel uncertain, what do you think is the biggest risk that they face when they start talking about implementing that strategy and maybe becoming too conservative?
Happens sometimes, I think, is that people react to principal risk, and they think that if they can eliminate principal risk, or risk that their principal can fluctuate down dramatically, they think if they can just get rid of that, then all their problems are solved. But what really ends up happening sometimes is that you replace principal risk with purchasing power risk.
Yeah.
And if you look at it, both of those two things are the extremes of what we look at sometimes. You certainly don't want principal risk, but you also don't want purchasing power risk, because both of those things can really hurt you long term. We always try to change the conversation to, listen, there's a middle ground between the two extremes, purchasing power risk and principal risk. Let's talk about what alternatives there are to mitigate or reduce the chances that you're going to do either one of those things and hurt yourself long term.
That's right. And that's exactly the challenge. Most retirees don't need maximum growth, but they usually need some growth, because the goal isn't simply preserving dollars. The goal is preserving purchasing power. One thing that we do here at Texas Hill Country Advisors is discuss risk, portfolio risk, and other types of risk when we're talking to clients. And I feel like we would tell you that if you leave that part of the discussion off the table, you're really not getting a holistic view for your financial picture, your financial goals. We have something called the Watershed Wealth Strategy. It's just about how much we should allocate based on your personal situation to each one of these different pieces of the puzzle. Segment 5, the big takeaway for today and this week. So let's wrap things up. This week's market story wasn't really about earnings. Earnings remain strong. It wasn't really about the economy. The economy remains resilient. It wasn't even really about inflation. This week's story was about expectations. Investors are beginning to accept that interest rates may remain elevated longer than many expected before, and markets are adjusting accordingly. The good news, strong earnings remain supportive. The economy remains healthy. Corporate America continues performing well. And while markets may experience some volatility as expectations adjust, volatility is just a normal part of investing. If there's one takeaway this week, it's this: don't confuse short-term volatility with long-term risk. The headlines will change, the market narrative will change, but successful investing still comes down to having a disciplined plan and sticking with it. Gilbert, thank you for joining us as always.
Thank you for having me.
And thank you guys for joining in for another episode of Main Street Money. We're Texas Hill Country Advisors. You can find us online at texashillcountryadvisors.com, on Facebook, LinkedIn, and YouTube. Thank you guys very much. Have a great weekend. We'll catch you back here next week. Securities and investment advisory services offered through LPL, a registered investment advisor, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.